Juerg Kiener, Managing Director and Chief Investment Officer at Swiss Asia Capital, had to tell us on the possible trajectory in crude prices. Let's hear him out.
The futures market is driving very big yo-yos, whilst actually regional issues on getting access to that material at the same price is almost impossible. In the meantime, what we have is a slowdown of the economy, particularly in the United States. Whereas if you look at the Chinese economy, it's been pretty weak, but there we have already seen stimulus. I think I more or less agree with what he's saying. I have to specify that because, as you know, oil prices are swinging depending where you are in the world, depending what your infrastructure and logistics right now is. So we've got very big dislocations. So probably people who get oil at significant discount to the $80 we are today. And there are probably some people who pay significantly more due to logistic issues. So the spread is actually quite big, and therefore the futures market is not really representing actually what's happened on the ground on the end for the end consumers. The question is, how much more can US actually tighten in that environment where the dollar is already getting reasonably strong towards 110? And I think at the price level, probably people will start thinking a slowdown on tightening might be in the card, particularly as the recessionary environments are actually appearing almost everywhere around the world. So I think what we have now is that the financial markets are discounting now recession in the commodity space, whilst actually low inventories and problematics we have on the ground might actually prove that by next year or by later the year, we are actually moving back into a shortage crisis. And we see that by backwardation, we see it on the curve, we see it in delivery issues. So commodity prices will probably go up again for end users.
Okay, all right, that's about crude.